Alright, so today's bank is CLST Bancorp. It's located in Louisiana. I think it's been operating since maybe the 1920s, but only recently, maybe 2021, 2022, they converted from an MHC to a bank holding company, so from a mutual holding company to bank holding company. So at that point, they became publicly traded. So they've only been publicly traded for a few years, and mutual holding companies where legally the bank is owned by the depositors, but then for the bank holding company, it's publicly traded. It's owned by the shareholders, like me and you, right? Well, we don't own it, but individuals or companies. And so they've got about 6 branches or so it's a really, really small bank, at least in the universe of publicly traded community banks. So they're really, really small company, and we can see that on the Yahoo Finance page as well, where it's a market cap of about 50 million. So that's probably one of the smallest banks that we've seen in our population of 340 publicly traded community banks. So really small and relatively young to the public markets, but they've been operating since the 1920s, so really old bank. It's interesting to see the trajectory of this price, because most all of the banks that we've seen over the past year that we've been looking at recently, they had sort of an uptrend right there, and then another uptrend right here, and then they sort of decide whether they're going to go up or down year to date, right? But this bank has just kind of had just a downward trend the entire time. Not sure what happened right here, but it's a very different price action compared to most community banks that we've seen so far. So that's interesting. Also, we can see the PE ratio there's nothing here, which probably means that they have a loss in their income. So then, Yahoo Finance doesn't want to present a negative PE ratio. That wouldn't make sense, right? So anyway, more than likely they've got a loss, and it looks like, yeah, so $1.02 per share loss. I'm not sure what time period this covers, but also maybe no dividend. So maybe we're looking at an underperforming bank. We'll see once we start digging into things. But if we come to the statistics page, we can see that the trailing PE is really, really high. We're looking for somewhere around 10 times earnings, right, on the price. So the bank is more than likely very underperforming, very low earnings. But interesting, the price compared to those earnings has been pretty high over the past several quarters, but it's slowly been creeping down. Eventually, maybe it'll get closer to the normal average of around 10 times, Also, we've got a price to book of 0.65, which is really, really low. Perhaps that's more of the gauge that the market is pricing the bank on instead of the earnings. If they're relatively new to the market and are having losses, or at least very, very low income, it's sort of hard to value a bank in that way, but then on their earnings, right? But you have the hope or prediction that at some point they're going to become earning profits in line with that of the normal bank, right? But it doesn't seem like that's the case at the moment. But we'll see once we start digging into things. So we can see, yeah, return on assets negative 1.5%. We usually like to see about 1%, right? So negative 1% is the complete opposite way. Same thing for return on equity. Yeah, so it seems like we've got a bank that's earning losses, and we're really not in the business of buying banks that lose money, right? So, but we can continue going through things and see if there's any redeeming qualities or anything interesting about the bank that we would keep in mind for the future when we look at the bank again. So we can come over here to the balance sheet, and we immediately see that, well, as far as the assets go, it's $282 million of assets. That's really, really small. I mean, most banks have at least, right around $3 billion of assets. So let's see. Yeah, the median bank in our population has $5 billion of assets. So $282 million of assets, that's really, really small. And we can see that most of them are made up of, not most of them, but a lot is made up of cash. They have $76 million of cash, which represents about 27% of the assets. So that's a lot. Most banks in our population have around 5%. So this bank has 5 times the amount of cash than the average bank does. And so, on one side, that's good from a liquidity capital standpoint, right? But on the other side, it's bad because they're not earning a good yield on, or at least as much of a yield that they could be earning if they had that in loans instead. Or perhaps if they bought securities with it as well at the current rates. So we can look at the securities as well. We've got 25 plus 13 million. That gets us about 15% of assets, which is about average. So we also have some loans here of about 140 million. That's about 50% of the balance sheet, so 50% of the assets. And that's a low amount. Most banks have somewhere between 70-75% of their assets in loans. So what we have here is a bank that is really heavily allocated toward cash and less allocated toward loans, which gives them a little more liquidity. But also what we see, if we divide the assets by equity, that's about 3 times leverage on equity, which is a really, really low amount. Most banks will have somewhere around 10 times equity in assets. So a leverage of about 10 times their equity. So I think what we have here is a bank that more than likely has really low interest income, because at least compared to the average bank, because number one, they're less leveraged, so there's less assets that are being invested into earning assets, and also they have more allocated toward cash and securities as opposed to loans, and that also puts them at yields that are less than what the average bank has. So those two things more than likely make them have a pretty low interest income compared to most banks. But we'll see whether that's the case once we get to the income statement. So coming down to the liabilities, so in conjunction with the leverage of 3.5 times that we talked about previously, that would be a benefit on the liability side. That would mean that they have less liabilities, and perhaps that helps some on the interest expense side, right? And so they've got about 28 million of non-interest bearing deposits. Of course, we would like to have as many of those as we can. This represents about 14% of their liabilities, so a little on the low side. Have a little bit more debt than most banks do as a percentage of the liabilities. There's about 15%. So a little bit more weighted toward higher funding costs than the costs of deposits, but also they have a pretty low leverage, so less liabilities on the balance sheet as a whole. So maybe those, it seems like maybe their interest expense will be a little bit lower than the average banks because of that, but we'll be able to see when we get to the income statement. So we've got, let's see, on the income statement we got 3.2 million of interest income, and that represents about 4.84%, and that is on the low side right now. That's pretty low. 4.84% yield on assets. Yeah, so that's probably in line with what we were talking about earlier, where, number one, not a whole lot of leverage, but also more allocation toward cash. So that puts us in a position where the interest income is maybe not as much as what the average bank might have. And interest expense, we can see, is about 1 million, and that represents about 2.2% interest expense. So that's a little bit low as well compared to most banks currently, and that might be because of what we talked about, from having less leverage, so less interest expense relative to the assets as a whole. Anyway, so those two things together, less interest income but also less interest expense, puts them at sort of an average net interest income. So 2.1 million, and that's about 2.9ish percent net interest margin, which is pretty average. Most banks have somewhere around 3%, so 2.9% is pretty good. That's that's a really great ratio. The only thing is, I think that due to having less leverage, it doesn't give them enough net interest income to overcome the non-interest expenses. Because presumably, if their leverage is 3.5 times and most banks is 10 times, then they could perhaps multiply this net interest income by 3 times, or at least 2.5 times or so, to put them in line with the leverage of an average bank, and that would catapult this net interest income to something like 4 million, 4.5 million. So as it is, they're in a position where they really need to ramp up their deposits as well as the investments in the assets so that they can create some more leverage and add some net interest income to the income statement. It could be the case that they're used to operating as a mutual, as an MHC, right? Where the depositors are the customers, so there's not really the incentive perhaps to create that much of a leverage or risk in order to earn more profit, right? But now, they're a publicly traded bank. They need to allocate their balance sheet in a way that matches the average bank in the publicly traded banks, right? So if they do that, they could increase their net interest income, presumably, by up to 4 or 5 million, something like that. Because they do have good margins or spreads. So anyway, if we come down to the non-interest income, so we've got sort of, they don't have any of the typical ancillary services that a larger bank might have, like wealth management, insurance. It doesn't look like. So there's not those extra fees that they can earn. So basically, what we did is they sold some of their securities and had a $5.5 million loss. We basically take that out as sort of a one-time thing and pull it down out of the income statement. And so that leaves about $300,000 of non-interest income, which is about 9% of the revenue, so that's not too bad. We normally see somewhere between 10 and 14%, so it's an okay amount of non-interest income, and it's excluding this $5.5 million, which we sort of take out. So now we get into the non-interest expense. It's about 2.8 million, which as a percentage of revenue, that's 82%. And that's a really, really high percentage. It's about double what we would see for most banks. And I think that's due to what we were talking about, where they don't have as much leverage on the balance sheet as what other banks do, so their net interest income is about half or less of what an average bank would have. And so the percentage of the revenue is double from the non-interest expense side. So what they need to do is leverage up so that they can cover these non-interest expenses, and hopefully they're working on that. Anyway, so basically their net income comes to about negative 4.5 million. And so if we add back this 5.5 million, less adjusting for the tax effect of it as well, it gives them still about a $500,000 loss, even by helping them out by pulling this 5.5 million securities loss out, right? So they have a loss for the quarter. And, as we mentioned, we don't buy banks that are losing money. And we can't really predict the future either. We can hope that someday they'll turn it around and they'll be profitable, and maybe we could get a good price for it today, but we're looking for high quality, profitable banks with risks that are reasonable and for a price that's reasonable, right? We're looking for base hits. We're not looking for big time home run investments, right? And so this probably isn't a good fit for us, but let's keep going and learn a little bit more about the bank and its risk and how it's structured. And someday it could become a bank that better meets our standards. So here's a little bit of information about, the 6 branches, started in 1922. It used to be St. Landry Homestead, FSB, but now they changed it to Catalyst Bank. They became a publicly traded bank in 2021. Yep. So let's go down to a little bit more of the footnotes. So we've got the investment securities. So the mortgage-backed securities are about 60% of the securities portfolio. We've got both available for sale and held to maturity here. And so then about 32% is U.S. agencies. So that leaves only about 7% that's munis. So basically the entire securities portfolio is riskless, and so it would make sense that there wouldn't necessarily be some kind of allowance for losses or anything like that, or at least a material one, right? So then we can see a little more of the term structure, duration as well. So it looks like most all of them mature 10 years from now, about 65% of them. So, that's not unusual. Most all the banks that we see have most of their securities mature 10 years, 5 years from now, and it's fairly usual, but it's also a big risk because most of them are trapped into really low rates that were in place over the past 5 years or so. So they're trapped into those lower rates for at least 10 years. That's a risk for interest rate risk. But I do like that the bank is selling securities, even though they've got to take a loss on the income statement, right? But they can sell these securities and redeploy them into higher yielding assets, either loans or other securities at higher yields currently. So I think that's a great policy. I think some banks might be a bit apprehensive to do that because then they have to put the loss on the income statement, right? But I like that they have the courage to do that. And yeah, so you can see the unrealized losses they have in place, about 6 million. It's not really as bad as not really as high of a loss as what we would see for a lot of banks, and that's apparent from them perhaps selling some of the ones that they have losses with. It makes the unrealized loss not as large now. So in our analysis, we're looking at, well, how is the bank now, right? So the fact that they had that 5.5% loss this quarter is not important to us. We want to know how is the bank situated now, and how what would be its normal profit going forward on with the way that it's structured now. So yeah, so they basically say they didn't create an allowance for any losses because the unrealized losses are due to interest rate changes, not necessarily to credit factor. So it makes sense to me. So coming down into the loans, we've got an unusually high amount of residential mortgages, about 82 million, which represents about 57% of the loan portfolio. And that's about 3 times what we would normally see. And I think it's due to it being an MHC before now, which would be more geared toward home mortgages, right? So the thing about companies having, or banks having, residential mortgages in their loan portfolio is that those could possibly be really long term and at really, really low interest rates, right? So, 3.5% for a 30-year fixed mortgage or something. So not to say that that's what they have on their loan portfolio, but that's a possible risk. And we'll learn a little bit more, I think, later on about what's in their portfolio, but that could be part of the reason that interest expense is a little bit low. But on the flip side, whenever we're calculating regulatory ratios and things of that nature, the residential mortgages basically have a zero risk adjustment for the risk-adjusted regulatory ratios. So it creates a lower risk for the bank by having those loans, but that's also a lower return. So that's the trade-off that we make. We also have a little bit of commercial real estate, construction land, multifamily, and some C&I. So those are all a little bit on the low side compared to the average bank. I bet the bank is probably taking steps to more align itself with the normal community bank, whereas getting more into business loans or commercial loans, right? So commercial real estate, C&I, that type of stuff, which they've probably been working on since converting to the bank holding company. So at some point down the road, they might have the structure of their loan portfolio a little bit more aligned with the normal community bank as opposed to being more allocated toward residential mortgages. But that's where we are now. So we can also see the allowance for credit losses. It's about 2.1 million. That's a really high amount. Most banks have somewhere between this is 1.46% of the loan portfolio. So most banks are somewhere between 1.10, 1.25. So them having almost 1.5% of the loans having a reserve on it is a really good conservative reserve. So then coming down a bit to see past dues, non-accruals. Here we go. Okay, so we've got total past dues right here, 3.4 million. Non-accruals of about 600,000. It's current and non-accruing. So there's another portion that's non-accruing. Anyway, this makes it a bit nuanced, but I think we can piece it together. Okay, yeah, so the non-accruals in total are about 1.5 million, which is about 1.05%. And that's a really high amount. It's at least double what we would see for most banks. That's interesting. And residential mortgages are the ones that are all non-accruals, which doesn't seem like that should be the types of loans that are in such poor shape. Anyway, so then we can calculate the non-performing assets. So non-performing is non-accruals plus 90 days old and accruing, which is only about 29,000. So it's essentially the same as the non-performing assets, but plus any OREO, which I think that ends up being on the balance sheet. Let's see. So yeah, foreclosed assets 200,000. So that makes the non-performing be 1.5 million plus 200,000, which gets us 1.7, and that's about 1.18% of the loan portfolio. That's really high too. That's somewhere between 2 and 3 times what we would typically see for most banks. Ouch. So then the past dues end up, we can say it's 3.4 plus the 600,000, so it's about 4 million. And wow, that's 2.79% of loans. That could be like 4 to 5 times what the average bank typically has. That's an astronomical amount. I do that right? 3.4 plus 600, yeah. That's interesting. So it almost seems like, we had a little bit higher of a reserve, but not high enough to mitigate the risk of 4 to 5 times the normal bank amount of past dues being present in your loan portfolio, right? So that's real interesting. We can kind of make some comparisons to things in a bit to see, how does that make sense? I mean, we already have an unprofitable bank as it is, so, adding in the risk that a higher ACL provision should be in place, then that adds some more losses, potential losses down the road, right? So we've got here the credit quality indicators, and we usually look at the classified loans, so those that are substandard and worse. These are loans that are inadequately protected by the net worth or paying capacity of the customer and its collateral, and that there's some known weaknesses that make it difficult to get the full amount be paid back. So it's not that this entire amount would be lost, but there's generally weaknesses within these amounts, the ones that are classified. And so we consider those at risk of having at least some kind of loss, right? So we can add all of them up, all the classified, substandard, doubtful, and it comes out to about 2.8 million. And so that's about 1.95% of loans. And that's a really high amount. We typically see somewhere between 1 and 1.5% of loans having classified. Currently that's about where it is. So having almost 2% of the loans classified means that the loan portfolio is a little bit less quality than that of the average bank, which is really surprising since they have a lot of residential mortgages, which presumably should have a little bit higher quality risk, right? Because for other banks, it's been the commercial real estate that's been having the tough time, or the C&I, right? So if we take into account all those factors where, the past dues were almost 3%, the non-performing was over 1%, the non-accruals were over 1% of loans, which are really, really, really high percentages of loans compared to most other banks. And so when we take those variables and compare it to what the reserve is, right, then the ratios we get for that are really low compared to what most other banks are. So that tells us that the reserve is a lot lower than other banks in the face of the past dues, non-accruals, non-performing, all those types, classified loans. So that tells us that I think they are under accrued for their reserve for loan losses. And that would mean that in future years, as more of their loans become doubtful or get into a place of non-paying, etc., then they're going to need to increase their reserve, and that would require a hit to the income statement. So currently the reserve is about 2.1 million and the classified loans are about 2.8 million. So if you kind of think like, okay, well, they need to add a reserve of about 700,000. And the reason I am thinking that way is because typically most of the banks have a reserve that's at least about one. It's about 1-to-1 with the amount of classified loans, right? So adding 700,000 to the expenses in their income statement is essentially a third of their net interest income, or maybe a quarter of their non-interest expense. So they already have a loss. So then they're looking at, in the future, possibly adding another $700,000 of expenses and exacerbate this loss further if this continues to be. We saw that the reconciling out this or normalizing out this loss on the sale of securities puts them at a loss of $500,000 on their income statement that we can consider as, this is our going forward normalized income to expect. Then that puts them even farther into the red, right, by adding a provision. So anyways, that's just a risk that we will be taking by buying the bank and its loan portfolio, right? So let's get back down to where we were. Deposits, borrowed funds. Yeah, so we can see the borrowings are about 29 million, and it's pretty much all Federal Reserve or FHLB borrowings. Pretty good rates on those, actually. So, less than 1% for some of them. 4.76% is a really good rate. But, the Bank Term Funding Program was a one-year loan, so that should reprice soon at higher rates if they decide that they want to take out another advance. Yeah, so they've got 23 million maturing within the next year, and then a little bit maturing 1 to 5 years from now. So that's the interest rate risk we take by having the liability side reprice fairly soon, right? So we'll kind of compare the repricing of the debt with repricing of the assets and securities, etc. later on when we get to that part, and we'll be able to kind of put together a conclusion on how risky is the repricing. They've also got some more that they can borrow from the FHLB and the Federal Reserve, so we'll get into that once we get more into the liquidity and capital part further down into the MD&A. But we can see that the regulatory ratios are fantastic, right? Most banks are somewhere between 10 and 13, 14% for all of these ratios. Meanwhile, this bank has 5 times what the average bank has for these regulatory ratios. And that's because, number one, I guess they're not as leveraged as the average bank. But number two, they're a little more allocated toward residential mortgages, which don't get dinged for risk adjustments and in these ratios. So, that's great. They've got such robust capital in place, but as we saw, they're not making much money because of that. So, and from the Yahoo Finance page, we saw it didn't look like they had a dividend. At least there was not a dividend yield there, so presumably they don't have a dividend that they pay, but they do have some shares that they repurchase from time to time. Looks like they added about 200,000 shares. The board approved that they can buy, which is about 5% of the company's stock. And during this quarter, they purchased about 200,000 shares. That's about 5% of the shares outstanding as well, I think. And they bought them at $12. What's the price of the bank now? $11.69. Yeah, they've just got too much cash. They need to be putting that cash to use. I mean, I don't run banks. I buy banks, right? So they might know better than I do about what they should or should not do, but I can see that it's not profitable. So now we're into the fair value measurements. We typically convert from the carrying amount, which is what is on the balance sheet, to fair value to see, you know, how is the bank priced relative to the fair value of its net assets, but also how much capital, like common equity capital at its fair value, does it have, and does that make their capital adequate? So the two things that normally have a difference between carrying amount on the balance sheet and the fair value is held to maturity securities and the loans. So they've got both of those here. So we can see that 13.5 million converts to a fair value of about 11 million, and then 141 million down to 136 million. So all that together changes the equity on the balance sheet down about 8 million, which isn't that much. It's only decreases the equity by about 10%, which is a lot less than what we would see for most banks. So by converting to fair value, they don't take as big of a hit as a lot of banks do. And so if you look at the tangible fair value of the bank, so that'd be the assets minus the liabilities, the fair value of the equity comes to about 75 million. Yeah. And so the market cap of the bank is 50 million, right? So you would basically be buying the fair value of the net assets of the bank at about 71% of their value if you went and bought at the stock price. So that seems pretty cheap just by looking at the net assets, right? But the risk that you run into is that the bank could continue having losses, and so then even though you bought the net assets at 71% of their value, your losses eat into that margin that you have there. So I do feel like they will more than likely turn things around. You know, in reading the 8Ks, I believe they've pretty much overhauled their entire management team and have a totally new CEO, CFO, chief operating officer, etc. And so maybe they're putting people in place that have a little more experience in community banking, or at least, you know, for publicly traded companies, and can maybe create value out of that. But so anyway, like looking also from the capital adequacy standpoint, the net asset value of the assets minus liabilities at fair value of 75 million, if we divided that by the fair value of the assets, it's about 27%. So the fair value of the equity represents about 27% of the fair value of its assets, which is a really, really high ratio. So that means that they've got a lot of equity capital in place compared to the amount that most banks do. So 27% is probably, it's about 5 times the ratio that the average bank has in place. So they've just got really robust capital in place. And that's also why the regulatory ratios are so high, and also why we saw that there's not as much leverage on the balance sheet that's apparent or corroborated by this as well. So, you know, as we discussed, that means that they aren't making as much money either. So, all right, so we're finally down into the MD and A. And we can look a little bit at the yields. I would be interested to see the yields. Yeah, we can see, you know, the ratios of the allowance to non-accruals, allowance to non-performing, and those are all below what we would typically see for most banks. So I feel like there's not an adequate reserve there, as we were discussing earlier. Now here's all the yields for the securities. These are all really, really low yields, below 2% for most of them. That's crazy. Most banks are at least, their securities are, at least for this quarter, are showing 3%ish. And so if you invest at current rates, it could be even more than that. So it's interesting they've got just such low yielding securities. And that's not good from the same discussion we were having earlier where these securities are locked in for 10 years. So they're locked in for 10 years at earning 1.88% on their securities. They probably pay more than that for most of their deposits. So that is not good. So they talk a little bit about their deposits here. We look at the call report, and they've got a pretty low amount of uninsured deposits, pretty low brokered deposits as well. So, at least lower than what the average bank has. So not really a big risk there in our opinion. But now we're into the yields. We can see the loans are yielding about 6.17%. That's actually really, really good. That's surprising given that they've got so much single-family mortgages. So that's a really good yield. As we saw, the securities are about 1.72%. Wow, that's just really, really low. I mean, most of the securities now are yielding around 2%. So that's really eating into their returns. And then the other interest earning assets, so their cash could be possibly earning 5%, something like that, which is great. But they can originate loans for a lot more than that. They can purchase securities for a higher yield than that too, presumably. So having so much cash sitting there earning less than what they could originate is sort of holding their interest income back. Not to mention the leverage that they are lacking. So, and then on the deposit side, as we talked about, it's a little bit on the low side. These deposit yields are pretty low. I mean, that's a pretty cheap yield, 1.43%. That's below the range than even last year when interest rates were lower than we would have seen then. So this is really cheap money right here. It's pretty low cost deposits here, and they creates a yield of 3.15%, which is really, really good net interest margin. And we saw that on the income statement, right? I think it was 2.8 something percent on there, so 3.15%. It's really, really good. This is an average, based on the average balance, right? We were looking at the ending balance whenever we're looking at the balance sheet. So anyway, so they're making a good spread here and a good margin on the assets, but unfortunately, since they're not as leveraged, that's not translating to a lot of money on the income statement. So it would be nice to see them leverage up and get more in line with the income of the average publicly traded bank. All right, so now we're into the liquidity side. I think this is an area that they shine, right? Not taking into account the money they're leaving on the table. But they do have a really good liquidity position, a really good capital position. I mean, they have $76 million of cash, which is a lot more than most banks have as a percentage of their assets. They also see about 60% of their securities are pledged. So if you add the cash to the unencumbered securities, that equals their on-balance sheet liquidity, and that comes to about $90 million, and that's about half of their deposits. So on-balance sheet liquidity is half of their deposits, and that's got to be 5 or 6 times what we would see for most banks. Most banks have somewhere between 12-18% on balance sheet liquidity, 12 or 18% of their deposits, right? So this bank is really, really liquid relative to the amount of deposits it has and relative to how liquid other banks are. So that's great. And so even when you add in how much available borrowings they can have from the FHLB and the Federal Reserve, they also have an extra, it's 32 million plus 17.8 million. And so that gives them in total on balance sheet liquidity plus these amounts gives them almost $200 million of potential liquidity either on their balance sheet or off that they can draw from. And that's about 110% of deposits. And we never see a bank have more on and off balance sheet liquidity than the amount of deposits they have in their balance sheet. So it's a very unusually liquid and capital robust bank. As we saw, it's hurting them on the income statement. So that's the trade-off that you have to make. They've also got a pretty reasonable amount of commitments. I think this amounts to, it's about 28% of the loans currently, which that's pretty average. I think traditionally this is looked at as more of a risk thing, but we also sort of consider it a growth thing, right? Like we would like to see that they've got some commitments and perhaps customers will borrow more and then that equals more interest income, right? But so they've got a pretty average amount of commitments. And then we can see after their share repurchases over the past quarter, they've got about 25,000 shares left that they can buy. That's not a whole lot. So that gets us to the end. I think let's see, did they talk about interest rate risk? I don't think. They must not have discussed interest risk. Interesting. It's pretty important and also a very common disclosure in DNA. I don't think I overlooked it either. But no problem. We do our own calculations based on the MD&A anyway. So I think we find that the interest rate risk is about average to that of most banks. As we saw, most of the securities reprice at least 5 years from now. So that is about 83% of the securities portfolio reprices at least 5 years from now. So, and we saw those are really, really low, at really low rates, right? Like 1.8%, something like that. So they're trapped into those rates for at least 5, 10 or more years, right? So that's not good. But the good thing is that they have almost half of their loan portfolio reprices in the next year. So that's fantastic. It's about $65 million that reprices in the next year. So at that point, they will presumably reprice at higher rates, and the bank can be making more interest income at that point. But on the flip side, so on the liability side, about 80% of their deposits reprice in the next year. So that would be the time deposits that mature in the next year, as well as like savings, money market accounts, stuff like that. So it's about 80%. If you remember, sort of a below average amount of their deposits are non-interest bearing. We prefer them to be more, but if they had more, then those would reprice as well. Or excuse me, so if they had less, I'm getting us all mixed up. So the lower amount of non-interest-bearing deposits means they have more interest-bearing deposits, which reprice relatively quickly, right? And then as we saw, most of their debt reprices in the next year as well, which it doesn't end up being a very large amount of the income statement anyway. So, all that together puts them at sort of an average interest rate risk, which currently for most banks is all a little bit on the liability side. I usually prefer a little bit on asset sensitivity on the bank asset liability management, but as it is, it's sort of in line with where an average bank's sensitivity is, which means that the bank is not necessarily going to get squeezed on net interest income by more than the rest of the banks that are positioned in the same way, right? So there is a chance that their interest rates could, or the net interest margin could get squeezed further, but the same thing would happen to all the other banks that are positioned this way, right? So if we're making our investment decision based on comparisons to other banks and deciding which ones are more favorable, then this bank is right in line with the other banks as far as the interest expense or interest risk. But I mean, I think another risk of so many loans repricing next year is that already the bank doesn't have enough leverage, right? They should probably have 3 times more leverage than what they have right now. And so as those loans reprice, I don't know if they're repricing because of floating rates or adjustable rates, or if they're maturing within the next year. But if they're maturing in the next year, then the bank has some cash here that they would need to invest elsewhere or have the customer renew that loan or whatever it is. So then if the bank already can't leverage up enough, then what are they going to do whenever they get half of their loans land in their lap in cash, right? So that's a risk too, that at that point they'll be sitting with more cash that's earning a smaller yield than what could be earned with loans or securities. So anyway, that we don't have enough inside information of how things are at the bank to figure out how that should work, but that's a risk to us. So anyway, we're kind of at the bottom of things and sort of talked about enough, I believe. So let's try to summarize this thing. We saw that basically they don't make any money. They have a small loss right now, and we don't buy banks that are losing money. So already it's kind of a no-go. But and most of the loss and lower income is due to them not being leveraged enough. And if they had some more leverage, they could make more net interest income, and then that would cover a lot more of the non-interest expense, right? Right now, the non-interest expense represents about 80% of its revenue. So if they were to double their leverage, presumably, from an estimate, they could increase their net interest income by double, which would make the non-interest expense or the efficiency ratio decrease by almost that amount. So as it is currently, I think that they're just trying to work themselves out of the MHC mindset, plan, strategy, and more into, now we're a bank that needs to be making money, right? And so I think they're moving in that direction because they hired, I believe, a new CEO, CFO, COO, maybe a chief risk officer, things like that. So, there were several 8Ks that came out like that, mentioning new hires in that way. So, hopefully those people are pulling them into a direction of a more profitable bank and adding some more leverage. Anyway, so we can go through some of the risks, and one of the things that didn't look good was the credit risk on the loans. So they have, their usual metrics for poor credit quality were maybe double or triple what we would see for most banks, like the past dues and non-accruals, non-performing, classified loans. All those things were ratios of loans were double or triple what we would typically see, and I believe the classified loans might have been more than that. But so the reserve that they have in place was a little bit more than what we would typically see for most banks, but not 2 to 3 times more to match the 2 to 3 times of past dues and non-accruals. So in that regard, I felt like the reserve isn't necessarily large enough in light of all of the risk that they have in the loan portfolio. And it was interesting, most of it was in the residential mortgages, which is not typical. We would normally see most of the risk in the commercial real estate and the C&I, and the regulators see most of the risk there as well. So it could be the case that those residential loans risk are getting overlooked. But anyway, so poor credit quality, and there's a risk that in the future the provision would need to be increased to match loans that become doubtful or non-performing, and that would cut into the net income, which is already underperforming as it is. So that's kind of a risk that we don't want to take either. Also from the capital standpoint, as we talked about, the capital is their shining silver lining, I suppose. I believe their regulatory ratios were above 50%, and that's just incredibly unusual. Most of the time they're around 10%, so or 10 to 13%, and we converted their assets to fair value and compared it to the fair value of compared the net assets to the fair value of their assets. It puts them at sort of a common equity ratio of 5 times what we would see for most banks. So, they have a really good, robust capital structure in place. Plus, they've got a whole lot of cash compared to what most banks would have, and an average amount of security. So the on-balance sheet liquidity, I believe they had enough on-balance sheet liquidity to cover half of their deposits, it's got to be 5 or 6 times what a normal bank might have in place. And then also when you take into account the advances they can get from the FHLB and the Federal Reserve, they have more on-balance plus off-balance sheet liquidity than deposits on their books. And I don't think I've seen a bank yet that has that much liquidity in place. So, on the one side, that's fantastic. That's a lot of liquidity and capital that could weather any storms. But, on the other side, it's really hurting them from the net interest income perspective, that they're not as leveraged as the average bank. So they, hopefully at some point they figure out how to leverage up and get themselves into the leverage that's in line with the average bank. Otherwise, they're going to continue to not be as profitable. It's just the nature of how a bank works, right? And then from the interest rate risk side, we just talked about it briefly. And, it seems like the repricing of the assets and liabilities line up to be about the same as what the average bank is, which might be a little bit on the liability sensitivity side. I prefer my banks to be a little bit on the asset sensitive side, at least in this environment, especially in this environment where, there's a risk of rates increasing, but also the rates in the market currently are higher than those that are published in the 10Q and the financial statements now. So once the assets and liabilities reprice at the higher rates, the net income will either be increased if they're more assets sensitive or decreased if they're more liability sensitive. So I prefer them to be asset sensitive currently. Also, from a really long-term perspective, banks are naturally liability sensitive, right? They take really short-term deposits and other funding sources and invest them in long-term assets. I mean, that's the whole game, right? So all that to say, they've basically got their asset liability sensitivity structure of their balance sheet is about the same as the average bank is currently. So I could say they've just got average interest rate risk that's in line with other banks. So anyways, so those are all the risks. We've got really low profitability, actually making losses currently. Pretty risky loan portfolio and reserve that might be too small, but they've got a really good capital, and interest rate risk is about average as well. So we can kind of take all those things together and compare it to what's the market price, right? And so we typically like to compare the market cap of the company that it's trading at currently to its earnings on an annualized basis, but we can't really it doesn't make sense because they have a loss, right? So there's no way to say that they've got a high, I guess you can. They've got a really low return on assets, right? They're returning negative. So as we said, we don't buy banks that are losing money or that are below average profitability, right? So it's a no-go from the start. But some things you could think about, though, if it's a risk that you did want to take, or you were looking for a long shot, or you could consider that they're slowly trying to work their way toward being a more profitable bank. And currently, if you look at the market price compared to its net assets, I think you could buy the fair value of the net assets of the bank at 71% of their value, right? Because the bank's trading at about 50 million, and then the fair value of its net assets are 75 million. So you could really buy those net assets at a pretty cheap amount, and then hope that the bank eventually they start to leverage it up, and they start to invest more into commercial type loans that are yielding higher rates, and pull a lot of that back cash off the balance sheet and put it into higher yielding assets, and put themselves in line with a more traditional community bank that's publicly traded. And so if that were to happen, you could very well have bought the bank at a pretty cheap discount, and then at some point have a really well operating profitable bank that you paid 70 cents on the dollar for way back when, right? So but that's the risk that you take, and that may never turn itself around. Who knows? So we don't, I'm not able to predict the future, so I don't know what's going to happen with it. But of course, we're not going to buy it just because it's not profitable. Credit risk might be a little bit too high for us. But if you're a little bit more risk tolerant, it could be a possible good long shot. So go for it if that's your thing. Anyway, so thanks for listening, and let me know any of your thoughts or comments. Love to learn what you think, or if there's something that I could better understand about the bank or my analysis, definitely let me know. So anyway, yeah, thank you for listening, and see you in the next one.